Hi everybody, my name is Yohay Elam. I'm an owner and founder of ForexFront.com. We'll talk today about understanding recent market turmoil. 2014 really began with a very strong note. Just a short word about myself first. I used to be a retail trader and a computer programmer. I founded ForexFront back in 2008. The site focuses on fundamental analysis and I also touch technical analysis. We're going to talk today, I think almost absolutely about fundamental analysis, but mention a few breakouts. Okay, so what will we cover today? Talk about a few global themes. We have on one hand deflation in the developed world. It's a major theme. It's coming to the center and front and everywhere in the markets. On the other hand, we have inflation and the crisis in the emerging markets. Not all emerging markets are the same, and it might be only the beginning. We'll mention a few big breakouts that we've had so far in 2014. And then we'll begin talking about specific currencies. The stuff that I see as more certain that hasn't changed since the beginning of the year. The stronger US dollar, the ECB ready to act, both euro, stronger New Zealand dollar, and the Swiss peg, of course. And things that have changed, the Japanese yen might be decoupling from the Nikkei. The pound rally is expected on London prices. The Canadian dollar might be a bit oversold, and Australian dollar and its new levels. So we're going to talk about 30 minutes or so, and then have some time for questions and answers. Let's talk about deflation. Why is deflation bad, actually? If prices fall, I can buy goods for cheaper prices, and it's good for me as a consumer. Well, it may be good for me as a consumer, but when prices fall, everybody expects them to continue falling, and then they don't buy. When they don't buy, factories produce less. People lose jobs. There's less money available, less consumption. And this vicious cycle continues and continues. This is what happened in the 30s during the Great Depression in many countries over the world. And, Ben Bernanke is no longer the Federal Reserve, but central bankers have studied the Great Depression quite seriously, and they don't want it to reoccur. So high inflation is bad, but falling prices, deflation is bad as well. And this is beginning to happen, or there's a danger of deflation happening in the developed world. In the Eurozone, this could trigger a move in March. I think tomorrow we won't see the ECB act. Talk about it later on, but inflation is very low, under 1%. In the UK, we had high inflation, relatively high inflation during the years after the financial crisis. But now that inflation has fallen back to 2% target, it enables lower rates even while unemployment is falling. In Canada, that's the main reason for the downfall of the Canadian dollar. And in the US, it could slow QE tapering. And let's talk about deflation in Japan, which is also something apart from the Great Depression that scares central bankers, scares politicians. Japan had a lost decade. Now it already became, 2 lost decades. It has 20 years of deflation, falling prices. This time the government tried to stimulate the economy, but just accumulated more and more debt. Japan has a debt ratio of over 200% above GDP. It's much worse than Greece. Luckily for Japan, most of the debt is held inside the country. Nobody wants to turn Japanese, like that 80s song says. But Japan turned around in the last year. They took big action. They introduced new fiscal stimulus, more plans to recover Japan from the terrible disaster that happened 3 years ago in Fukushima, and the tsunami and earthquake. A much bigger blitz of the quantitative easing, printing of yen and buying bonds. And this has resulted in a lower yen. The lower yen helps exports and help the stock market, of course. But now what Japan is doing is very, very interesting. So with the lower yen, exports are becoming more expensive, and imports are becoming more expensive, and exports are becoming more competitive. But this might be especially energy prices, which Japan now imports. Japan imports energy after the disaster, much more than it did beforehand because of the closure of nuclear facilities. This is only the wide inflation measure, and Japan also wants to raise the core inflation. What is core inflation? Wages. So Japanese Prime Minister here on the right, Shinzo Abe, on the left, on the right is the Kuoda, the head of the central bank. He's calling for corporations to raise wages. If people earn more money, they can spend more money. This is good for the economy, assuming it doesn't get out of control. This is somewhat revolutionary, or, well, maybe revolutionary is an exaggeration, but this is a bold step. It'll be interesting to see if other countries will follow these steps in fighting the deflation. We've seen something in the United States with Obama calling for raising the minimum wage, but I don't think this will materialize. Let's wait and see. Now, let's move to the emerging markets. It began long ago, the Chinese credit crunch. The new regime there is trying to curb into the shadow banking. On January 23rd, the manufacturing PMI fell below 50 points. It means that China is contracting or growing less than expected. It joined also the worries about the taper that came, the second taper that came less than a week afterwards. Altogether, it sort of created this perfect storm. It joined outflows of cash from economies, especially those with the deficit, such as Turkey or Brazil or India, which had a trade balance deficit. And it sort of created a market panic for a while. Contrary to what I just described beforehand, weak currencies and contrary to the developed world, these countries sometimes have now a weak currency and higher inflation, and an even weaker currency lifts inflation even more. Argentina is probably the worst hit off, and Mexico and Philippines are doing better. Not all emerging markets are the same. There are huge differences. So some central banks, such as in Turkey or in India, took steps to curb these moves. So far, markets are calm. It did not, as I mentioned, didn't affect all emerging markets. Argentina is not Mexico. Turkey is not Philippines. But this and the result of this was the risk-off environment. What happens when markets are scared? Of course, stocks fall. And the US dollar and the Japanese yen strengthened, especially the Japanese yen. So far, it has calmed down, but it could be just the tip of the iceberg. It could continue with another flow, with more tapering or another crisis in one country to scare investors from other countries. So it's something to watch out for. Now, another theme we've seen so far in 2014 is big breakouts. Pound dollar reached the high of 166.68, the highest since May 2011. The Aussie fell as low as 86.60, highest since July 2010, and the dollar CAD went as high as 112.24, the highest since July 2009. These are multi-year breakouts. Of course, these were only the majors. We've seen breakouts in other crosses. I assume that many of you are trading euro-dollar, and that has been somewhat boring. Hopefully we'll see some change. After the breakouts, we saw these currency pairs retreat back to previous levels, but I believe we'll see many more breakouts, and this is an exciting year. These breakouts are opportunities. They're usually accompanied by high volatility. They're big moves. This, of course, offers opportunities to trade, and they're accompanied by high volume. And what I've seen so far is that they allowed enough time to catch the long-term moves. I think we'll continue seeing that until the end of March, early April, until we have the Easter break. So this, of course, with the more moves in the market, there are more opportunities, but also more risks. So if you're trading the big breakouts, don't use extreme leverage. Now let's begin talking about specific currencies. US dollar, we've seen some issues in the US, some bad figures, like this week we had the weak ISM manufacturing PMI, but it seems that the taper train is on a preset course and it's not going to stop. The Federal Reserve under Elam is probably going to continue tapering unless something really, really bad happens. We've seen that in January, just 2 weeks ago. The bad non-farm payrolls for December that was released in early January didn't stop the Federal Reserve, didn't even mention the emerging market crisis. Some people blame the cold weather for the weak data. Anyway, today we had the ISM non-manufacturing PMI, which was A-OK, and ADP, which was A-OK. So the road is bumpy, as I wrote here, but the dollar is set to rise in general during the year as tapering continues and until QE ends by the end of the year. Now, two more things in this context is Yellen has entered her new job. It's the first time a woman is the head of the Federal Reserve. There are still gender differences and some discrimination. She will probably need to show that she's the man, she wears the pants in the house, and that she's tough. Unfortunately, that's how our society is. And in addition, the composition of the FOMC, the Open Markets Committee, Federal Open Markets Committee, has changed. It changes every year. It's slightly more hawkish now. There are 2 new hawks and 1 new dove. So instead of members that retired, so it's a bit more hawkish. Anyway, there are good reasons that we'll see more around the tapering. Another thing, I think I wrote it here, but the Fed took a long time to decide on tapering. It mentioned it in May and June, and then didn't taper in September, and then finally when it made the move in December, it's going for it full steam, tapering of 10 billion every meeting, and until it ends by the end of the year. So bumps in the dollar are probably temporary. The euro, tomorrow we have a very, very interesting rate decision in the Eurozone. I don't think the ECB is going to introduce new policy tomorrow. There is a chance that they will unsterilize bonds, but let's not talk about it. Anyway, deflation in the Eurozone is not going away. We've seen, once again, CPI and core CPI fall to minimum levels, 0.7 and 0.8. Prices are rising too slowly. This isn't good. The euro is too strong. It hurts exports. Money supply, M3, another measure, although second tier, but it's squeezing all the time. I can tell you here in Spain, where I'm located, that getting a loan from the bank for a personal loan or for business is quite hard. Another thing is the AQR, the asset quality review. It's a test that stress test that the ECB does to the banks. In order for the banks to meet the standards the ECB wants them to meet, the banks also are trying to improve their balance sheets, and this means less money for the real economy. One of the magic things to fight falling prices and the credit squeeze and to boost the economy is the lower value of the euro. This will help exports and move prices higher, encourage spending in the Eurozone and not outside. What is the ultimate tool that the ECB has? That's the negative deposit rate. What is the deposit rate? The ECB and other central banks have a variety of interest rates. One, the main lending rate is the rate at which the central bank lends money out to banks, and the deposit rate is the money that the ECB, interest rate the ECB in this case, gives the banks when they deposit money. The deposit rate in the Eurozone is 0. It has been, and the main lending rate is 0.25. It used to be 0.75 and 0. Now this corridor between lending and depositing is squeezed. This is the nuclear option, because if banks are punished to park money with the ECB, they have an incentive either to lend money to the real economy or to take the money out of the Eurozone. The ECB has been talking about a negative deposit rate for a long, long time. When they mentioned it back in May, for example, it really hurt the euro, but they can't cry wolf all the time. They can't just say we're going to use it. They also said we're technically ready. At some point, they'll have to use it. This moment is really getting closer. I don't think we'll see it tomorrow. I think we need to see another dip in inflation, the German hawk from the ECB, but I think that it'll happen in March. There are also other issues in the Eurozone. We've heard news now that Greece, not a big surprise, will need more money, and the recovery is very fragile. For instance, retail sales that were released today fell. As aforementioned, it's probably time to act. And one thing that can postpone action by the ECB to use this nuclear option to weaken the euro is that the euro will weaken on its own. We've seen that only marginally last week when the inflation numbers were released and the euro fell against the dollar, but the euro is still too strong against the dollar, against the pound. So only if the euro falls, I think, below 130, the ECB could wait and see. But I think it's coming and it'll hurt the euro badly. Another relatively certain thing, I don't know how many of you trade the New Zealand dollar. This is one of the stronger currencies and more interesting in my opinion, but somewhat neglected. Contrary to many other developed countries, and New Zealand is going to hike the interest rate. The interest rate there is 2.5%. We had excellent employment figures this week. We had big hints from the central bank last week that it's going to hike the rates in March. It's still not fully priced in. The New Zealand dollar suffered a big fall recently. It's mostly related to emerging markets, but and I think there's room for a rise relatively soon. So once we get, this is one of the things I also talked about in the previous webinar, and I think this hasn't changed too much. The factors supporting the New Zealand dollar are that it exports food. This is a more stable thing. It depends less on the situation of the global economy. People need to eat even if they're in a recession. Tourism is solid in New Zealand, and the Kiwi expats are coming back home. This is a trend that's continuing. Just unemployment rate is now 6% in New Zealand, and even though the participation rate rose to 68.9, in comparison, that's 7% more than the United States. So the economy is doing really well, and it should be supportive of the Kiwi. Another just very boring thing, the Swiss franc. It's 2.5 years since the S&P declared its peg, put a floor of 120 under Euro Swiss. It has been very successful. Don't fight the Swiss National Bank. Deflation is still a threat in Switzerland, especially when it's surrounded by the Eurozone. Anyway, nothing to see here. That's also, boredom is probably guaranteed for a long time. Now let's talk about more interesting things. Japanese yen, which has been a very boring currency in 2012, was very exciting in 2013, also in 2014. Emerging markets prices pushing the yen higher, and safe haven flows. Despite all that Abenomics and all the yen printing, the yen is still safe haven currency of choice. The emerging markets crisis is pushing global stocks lower. So far, the correlation between the Nikkei and dollar yen holds. What's this correlation? When Nikkei, the Japanese stocks, go up, dollar yen goes up, and when stocks fall, dollar yen falls. I think we've seen a crack in this earlier this week, and I think this correlation might break soon. So I don't know how. So far, it's been a very, very nice correlation. I'm not sure it will hold, and it might be a bit harder to trade this pair. Other factors moving the yen. As I mentioned before, after the terrible disaster almost 3 years ago in Fukushima, the nuclear disaster, the government shut down nuclear power plants, but as a result, Japan needs to import oil. It has a negative trade balance, a deficit, but they could essentially be open. There is less opposition to them being open. This could be supportive of the yen. Another thing that supports the yen is that in April, a tax hike is coming. I think it's already priced in. and it'll have a small impact, but still an impact to be aware of. And another thing, higher U.S. yields are weakening the yen, but I should also say that lower U.S. yields are also supportive of the yen. So as long as tapering goes steadily and U.S. yields don't go up too much, we can see another factor supporting the yen. So I think that in the upcoming period we can expect somewhat stronger yen, but the bigger picture towards the end of the year we'll have more weakening of the yen. But the picture has become a bit more interesting, a bit more complex since the beginning of the year. Yeah, British pound. Pound rally, since the summer, pound has been strong against the dollar, against the euro. Always been bumpy, always been not so stable. And now I think, the UK economy is growing nicely, but now people are beginning to look at the details. The details are not that convincing. We've seen growth mostly in the construction sector and housing. House prices are rising, especially in London, the financial capital of the world, or maybe together with New York. Anyway, we've also seen it this week. Construction PMI reached boiling hot levels of 64.6, the highest in 6.5 years, just before the bubble burst. While the rest of the economy is doing okay, it's not doing bad, but the PMIs are much lower, around 56, 58.3 today for the service sector. So I think the housing sector boom might spread out of London, but other sectors are not rallying. In order for the UK to continue moving higher, we need a stronger Europe and a stronger partner to buy British products, and we're not exactly seeing that. So there are doubts about the strength of we've already seen the pound fall. I think it can recover from the current levels, but we have to watch these doubts. Regarding the central bank, Mark Carney and his colleagues, unemployment is falling fast. The economy, yes, is recovering, is growing nicely, more than recovering, till to 7.1%. But the markets are beginning to believe what Mark Carney says. He said that rates will remain low even after unemployment falls below 7%. And he can say that quite easily because inflation is falling also in the UK. It's not the situation in the Eurozone, where there's a danger of deflation, but inflation used to be around 4.5%, at least above 3%, and now it's back to the perfect target of 2.1%, if I'm not mistaken. So if inflation keeps on falling, the pound could suffer. If inflation stabilizes, there will be more expectations for a rate hike, and we'll see the pound recovering quite fast. And was more bullish about the pound earlier in the year. Now I think the picture is more complicated. Canadian dollar, I think it's a bit oversold. Also Canada, like the Eurozone, like other regions in the developed world, is suffering from low inflation. It fell as low as 0.7%. It caused the central bank to change its bias from hawkish to neutral or neutral dovish, and the Canadian dollar lost ground. But I think the move is huge, and it's a bit too strong. The Canadian economy is still a robust one. Unemployment there is 7.2%, which is okay, and there's high participation rate. More reasons. So far, the fall of the loonie can't bring inflation back up. It fell a lot. Only a near zero, really zero inflation rate, close to deflation, can trigger a rate cut. I don't see the central bank in Canada, the DOC, cutting interest rates so soon. Markets will probably begin believing that shortly. Housing situation, there's been a lot of talk about the housing bubble in Toronto and Canada in general. I think as far as I see, it's still okay. The other factor to watch out for is oil. The U.S. government seems to be moving a bit closer to approving the Keystone extra large pipe. This will enable Canada Canada to export its oil from the tar sands out to the world. It's very controversial because it hurts the environment. But the U.S. government will probably approve it, and this might help the Canadian oil exports, which will help the Canadian dollar. This isn't good for, this might not be good for the environment or for the rest of the Canadian economy, but it might support the Canadian dollar. Another fact I didn't write here, something I repeat each time, Canadian economy is more dependent on the U.S. economy. If the U.S. economy is really improving, and that's the reason for the tapering, then the Canadian economy will improve as well. So I think the Canadian dollar suffered too much, and this could recover relatively soon. Australian dollar, another very interesting currency. They're contrary to Canada and more similar to New Zealand. CPI, the inflation rate, has been much higher than expected in the fourth quarter. This is clearly a result of the weaker Australian dollar. Imports are more expensive. So in the rate decision just this week, the RBA, the Bank of Australia, turned neutral. It sees rates remaining at the current level, 2.5% for a very long time. But I don't think it's the end of the story. I don't think the Australian dollar has room to rise. It may have bottomed out for some time, but it might stay around the bottom and could fall back. Glenn Stevens, the head of the RBA, mentioned an inflation rate of, an exchange rate of 0.85 as a comfort zone. And the pair got down to 86.60, now it's about 89 last time I looked. I think it could fall below 85 and more factors. Given past patterns, we could see another rally before the next dive. The fall of the Australian dollar since May 2013 in the past 9 months hasn't been a straight line. Well, like currency moves, the pair fell and then recovered and then fell again. This could be just another rally before the next dive. Australia is still dependent on China, and China isn't doing so safe. And the low Australian dollar hasn't been here for long enough. It has pushed up inflation just a bit, but did not help the real economy. Unemployment is going up, and the mining sector investment at least is over the hill. I think we could see after this current rally, we can see another fall in the Australian dollar. Okay, that's the review I prepared. What do you think? What is the next direction of currencies? Do you have any questions? Let's see if you had any questions so far. Any questions? While I'm waiting for your questions, turn to one of the points here. Glenn Stevens and his colleagues. Glenn Stevens talked about 85 cents as a comfort zone. One of his colleagues, Heather Riddett, I think her name is, she talked about 80 cents. So that may be a bit exaggerated. We had a bottom of 80.66 in the Aussie dollar a few years ago, but I think that 85 could be broken. We have technical support at about 85.70, but I think that 85 is a psychological level, and if we see it broken, we can see a big downfall. Okay, a question. What do you think about gold? This dollar in particular. About gold, I think gold has room to fall. I don't follow gold very closely, but I think that with tapering continuing as planned, you can lose the 1180 level and get towards $1,000. The correlation between the Aussie and gold hasn't been that strong, so I think it's better to watch China. Regarding the Australian dollar, and And if we look beyond China, it's the rest of the Australian economy. And retail sales that we have later on today, or tonight, housing sector, everything else. This could be the key for the next direction of the Aussie rather than gold. What about South African Rand, ZAR? Well, I think South Africa is one of the more vulnerable economies in the world right now. Lots of crime there, instability, follows commodity prices. It's not at the bottom end like Argentina, but much further away from the good emerging markets like the Philippines and Mexico. So the South African Rand reached multi-year lows against the dollar and other currencies, and they can continue falling in the ground of the crisis. The crisis is not over. More questions? Do you guys think the ECB will act? Will we see some big movements in euro dollar? I'm waiting for action over there, and euro dollar is a bit frustrating, I think, recently. No decisive moves, not up, not down. Or are you any of you trading the pound? Okay, another question. Movement of the Swiss yen. This is a cross I'm not really following. I don't like the Swiss franc in general. Both of them used to be considered as safe haven currencies. The Swiss franc is a bit stuck, so I see the yen as the ultimate safe haven currency. And the Swiss franc is basically going hand in hand with the euro. So if we have trouble, we'll see Swiss yen fall like euro yen. I think that euro USD is in a bearish wedge. Yeah, thanks, Michael. I also I've seen that pattern. I want to trade about it. It lost. It's a really squeezing triangle there. And I see it's falling as well. I don't have a chart to pull out at the moment, but I do agree. Euro is safe haven. It's a good question. With the yen around, it isn't a real safe haven. But some of the emerging market flows are going into Europe because emerging markets have provided a safe haven, a high yield. And when the money moves out of these emerging markets, some of it goes to the Eurozone. The European Central Bank basically guaranteed the European bonds with the ONP. And there are some countries like here in Spain, Portugal, that provide relatively high yields. So the emerging markets crisis has some positive impact on the euro, but I see it as very limited. I didn't mention it beforehand, because I don't see it as that strong. I think the events in the Eurozone are more important for the euro. Short USD. Well, I don't give specific trading advice. I'm more bearish on the euro at the moment, and I see it falling on the issues of deflation. Levels to watch are 134.50, and on the top side 136.15 are the levels I'm watching. But I don't provide stop loss, take profit, or in really signals. It's not my thing. Up on the momentum, yeah. If the ECB does nothing tomorrow, I think if it conveys a message of calm, I think we can see the euro climbing up. That's also a possibility. Mario Draghi, president of the ECB, did that in the past. He could do it in the future as well. Future is also tomorrow. But I see better chances of him warning about deflation, and sending the pin down. More questions? Okay. While I wait for more questions, if they come. So I'm pretty say thanks Ethic Street for hosting the webinar. It's always fun. You're welcome to visit forexfront.com. Contact me for further questions. My email address, Twitter handle. There are mobile applications for Android and iOS, and hopefully soon for iPad as well. Another question. Topped at 138.90. The top level that I see for euro dollar is not the 138.90, because that was the level that was reached when liquidity was very, very thin around the holidays, around Christmas, New Year. So I think that 138.30 is the big level to watch on the top side. I do think it topped over there, and that the ECB will eventually send the euro dollar down, especially if the non-farm payrolls report on Friday is okay. It doesn't need to be really good, just okay. But no, that's my opinion. It's still to be seen. 138.90. Any of you trade British pound? I had a really bad week. And Kiwi fell recently because of the emerging market. The economy in New Zealand is doing really well. And employment, when I prepared this presentation, I didn't know what the employment numbers would be. It was published last night here in Europe. But they were really excellent, so just strengthens my theory. The Kiwi has room to run. Of course, nobody wants strong currency, and both the central bank and the government complained or whined about the state of the strength of the New Zealand dollar. But they're doing well. It's a Western world economy, Western country, high yield. Once things stabilize, or even without stabilization in the world, I see Kiwi dollar is going up. It has room to rise. It suffered too badly also last week. Any more questions? We have a few more minutes. What are you guys trading? What happened with the US dollar today? It was a bit complex today. Earlier in the day we saw the ADP report. Was a very mixed response. I think it was generally positive because markets were scared after the ISM manufacturing PMI earlier in the week. And then there was a small miss in the ADP, but no big revision to last month's figure. It means that, in my opinion, the weak non-farm payrolls we saw for December will probably be revised higher, and it was a one-time glitch because of weather or something like that. And then we had a better figure from the ISM non-manufacturing PMI. The non-manufacturing services sector is, I think, 70-75% of the U.S. economy. And if it's still growing nicely and with a strong employment component, U.S. dollar has room to rise. We saw it rise against the Japanese yen. I think the previous webinar I talked about trading news about which currencies react best, and the dollar yen reacts best to U.S. releases. The picture was much more complicated in euro dollar and in pound dollar. But in general, we saw positive figures for the U.S. dollar, and we saw that in dollar yen, and I think other currencies will catch up. Also, especially in the euro, traders everybody's expecting the ECB decision tomorrow, and so that's keeping it on hold. Yeah, so that's a very, very choppy dollar indeed. I think it was a bit less choppy against the yen, but very choppy against many other currencies. If anybody's trading the Canadian dollar, we saw a very strong move, not only because the U.S. figures were okay, but because Canadian gold permits were terrible. So after the Canadian dollar recovered, after the dollar CAD fell, it made a strong move upwards. So that was calculated, and regarding the euro, I think the markets are a bit free towards the decision tomorrow. We also expect the dollar to strengthen against the yen in the bigger, towards the end of the year more than in the next month or so. Euro CAD, as I see it, fundamentally the euro is a bit weak and Canadian dollar suffered too much. So, so Euro CAD, I think, could fall in the long term. Any more questions? I think it can go even beyond 90 cents, but not too far, maybe 91, 92, and eventually we'll see another big fall after, I think, employment data will play a key part. We have employment data next week, and also Chinese figures. The Aussie sometimes reacts in a stronger manner to Chinese figures than to local figures. We have retail sales this week. So I think that in the course of a month or two, we could see both a rally and then dive below the previous lows. Moves are very interesting in the article. Okay. Any more questions? I think we can wrap up. Okay, guys, thank you very much again for attending. Thanks, FX3, for hosting the event. You're welcome to follow me, follow the site. All the contact details are here on the screen. Hope you enjoyed it. I wish everybody successful trading. And see you next time. Hope. Thank you very much. That's it.